You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupey as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
All right, everybody. Welcome to another episode of the Alternative Investor Mastermind. We've got a great show today. We've got Kelly Ann Winget, who is a visionary leader in the world of alternative investments and the driving force behind Alternative Wealth Partners. Kelly, thank you so much for joining. I'm looking forward to this conversation.
Thank you for having me this morning.
So I always like to start because, I feel like and I think we probably share this opinion, just too many investors are just stuck in the traditional financial system. They've got all their money in, stocks and bonds and really just never quite get out of it and experience the other opportunities out there. So tell us a little bit about your background and ultimately how you were able to discover and get more involved in alternative investments.
Sure. So I had the fortunate upbringing of two CPA parents. And so, money was not an off-table topic in our household. My parents were also, young entrepreneurs themselves, typically going against the grain anyways. They were flipping apartment complexes and starting businesses in the 70s and 80s and kind of carried that energy into, having children while running businesses. And then also, as my father went back into corporate, worked, several decades under PricewaterhouseCoopers, and my mother continued to work under privately owned businesses. So it was always something that I was exposed to early on. So when I, got to be a teenager and had to start making my own money because my parents didn't want to buy me nonsense, and I'm a teenage girl, so I want a lot of nonsense. So I got a job selling car washes in high school and made almost six figures part-time. So I learned how to make money quickly and easily in school. And so, when I graduated at that point, it was really hard to convince me to pay six-figure tuition to go to college when I wanted to work for operators out in the real world. I always loved business, and that was one of the things that I never thought you could be taught from a book about. So I worked in healthcare, I worked in construction, and ultimately ended up working for an oil and gas company. I'm 5 generations in oil and gas, so I was going to end up there anyways. I just happened to do it on my own. And that was my first exposure to private equity. And then from there, it was like everything else under the moon. I helped companies raise capital. I helped educate investors on the alternative space. I've worked in family office. And when I left family office in 2020 to start my own, that's when I decided that I wanted to democratize the space a little bit and create a diversified product in alts that didn't exist on the market.
That's great. And I think back to my childhood as well. My parents were very working class, and I sort of had that drive more from watching them struggle. But being an only child, the money topic was very much on the table. I was kind of talked to like an adult because I was the only one there. Everybody gets there in a different spot, but it's a great way to it's a gift that to be able to grow up and have that perspective so young. So
Absolutely. I think that people forget that, people from, where I came from. I grew up in an affluent home. I was very exposed to, wealth from the very beginning of time. But the other part of that is having parents that understood that that was not real for people. And so we were hyper aware that our lives were not normal and that everything we had was a privilege, and that we should make, decisions in our life that help other people get to where we were. It's why I wrote a book on, trying to demystify the wealth gap, how to close it, because I believe that wealth is for everyone, and that the information has been historically gatekept. I think we're probably aligned in that, and that you can actually do it with any amount of wealth, whether you're just trying to scrape by, or you've reached a point where you can start being more risk, take more risk in your investment strategy.
Yeah, and the thing is, alternatives, I don't even see them as more risky. The fact is, the S&P was down 20 something percent in 2022. It gained 25% in 2023. So I mean, net for 2 years, there was only a 2% return, and investors just have this. A lot of them have this just thought that anything outside of their financial advisor is risky. I don't know how many conversations I've had talking about whether it's multifamily real estate, self storage, just various real estate deals. And they said, well, let me talk to my financial advisor. And I was like, well, let me save you some time.
Yeah.
They're going to say don't do it because they're going to lose money if you pull money for that. So as someone who's in the same space, like how have you approached educating investors that are new to alternatives on the risks, the rewards, and how to compare it to what I'm sure we both think is an inferior investment, but at a minimum, people are mostly over allocated to.
Yes, I think that it is definitely a lack of information, a lack of education. And I think people need to understand that it's on purpose so that you don't move your money around. You have a couple thousand companies that are publicly traded when there are millions of privately owned businesses. Like, you're looking at a very small portion of the economy when you're looking at public equities. And so if all of your money is sitting with a handful of companies, then you are in probably the riskiest space you could probably be in. And I think that what COVID did, thankfully, was kind of wake people up a little bit, to try to start researching what else is out there to start investing in. And I do a lot of this education of, like, your advisor cannot talk to you about alternatives unless they are owned by the company that holds their license. Um, they are motivated by collecting a fee sitting on top of the money that they're managing on your behalf. And same with private equity funds and hedge funds. Like, we're getting paid a fee to manage that, but we're actively managing it. Where your advisor is like, plan 1, 2, or 3, and which is your risk tolerance. Um, there's a lot of opportunity out there, and it goes way beyond just a return. There's tax strategy around it. There's legacy building. There's charity. Like, there's all these other things that go into your investment strategy beyond just, at the end of the day, what's your risk adjusted return, which I also think that investors don't understand at all. Because even right now, with rates as high as they are, you're in a high yield savings or a CD or something. After inflation, you're still only making 1 or 2% maybe. So, like, investors don't think about that, and then you're taxed on that, right? So,
That's a great point for
a,
sure.
a big piece of what I do is thinking about what is your actual return at the very end of the day.
Yeah, I've had a few conversations. Again, I'm not an advisor myself, but high net worth people that have REITs. That when we compare REITs to private deals, rather than steal your thunder, why don't you talk through that? I'm sure you know the math on that as well, on the tax rate on dividends versus how a syndication may work.
Yeah. I don't do a lot of real estate. I think it's boring. It's and that's not to, like, beat down on any real estate people. It's just one of the most accessible alternative assets that you can get involved in. You don't need a lot of money. You can borrow a lot of money to buy it, and you don't technically have to be accredited to participate in a lot of those real estate projects. So I've heavily focused on private equity, venture, and direct investing in real assets, and then structuring that together to get a blended rate of return that's both tax advantage and risk mitigated.
That's great. That's something I know a little bit less about. I'm still primarily real estate syndications, and I generally do larger deals. In my 20s, I had rental properties. It sounds like, as someone who grew up in it, maybe you burn out a little bit. I used to say I don't want to deal with tenants and toilets, so I were generally 100-unit plus buildings that are more like running a business. But
Yes.
I've dabbled in a few venture capital funds through business school, and I'm even invested personally in a search fund. I don't know if you've done any of that, but yeah, let's talk through just maybe some real world examples of some of the successful private equity and just deals you look for, just good opportunities. Just love to learn more about that space.
So venture's gotten really popular in the last 10 years, especially last maybe 5 years, where more individuals are getting involved at the venture level than just say like a large venture fund of people that maybe came out of Y Combinator or had a large exit. Family offices are also starting to participate more earlier and earlier into businesses besides their own. And I think that the opportunity for investors really is, it used to be that you wouldn't find out about a deal unless somebody called you and told you about it, or you had a friend that was, in the space. There was no way for you to get access to privately held Facebook shares when they first came out, right? And that's changed a lot because there's a lot more insight into that space. There's angel networks, there's investment clubs, there's all these like places that investors can get involved to get educated about different deal flows. You can also just make up your own, kind of deal. And this is what you're seeing primarily in the real estate space. You go and find an asset that you can build value on, you put together a deal, investors get involved, and it gets run like that. You can do the same thing in the private equity space. There might be an industry that you're really, really interested in, and you can find distressed companies. You can either, or just companies that are doing really well that might want a capital partner, and then you can get involved at that level. We invest in everything from venture to buyout, so we have a really diversified portfolio. We typically don't invest at like an idea on a napkin stage. They typically have some sort of revenue being generated. They figured out who their customer is, and now they need money to grow. And then we've done some stuff where we've done distressed turnarounds. That's probably my favorite deal to talk about, and that's in the ammunition space.
In the ammunition space, that's interesting. Is that something? Is that something you can talk
Yeah,
about in a little more detail? I don't know if there's NDAs
sure.
or if it's private, but yeah, I think that's a good case study.
Yeah, so that was a project that I was invested in for quite some time, and then had the opportunity to buy all of the assets and essentially start a brand new company with a completely different management team, which is typically what some private equity companies do. Um, in most cases, they're going to remove, especially in a distressed situation, remove everyone related to the company because it just wasn't working out. That's what we've done. And so we've been able to kind of turn the company back around just because we had more experienced people that I was able to put in place. The long-term goal really is to change the narrative around like a demonized industry. Being 5 generations in oil and gas and having lived in California before, I understand what it means to like be invested in a demonized industry. And it's just about getting people to wrap their heads around, the fact that things exist for a reason. And if we can change the face of the narrative around that reason, that we can actually have a transition to a better, more sustainable future. The same with oil and gas. Like it's not going anywhere tomorrow. So how do we work with the industry that exists to help pay for that transition? The same in the ammunition space. There's a lot of political opinions about guns and ammunition, but if we can put the right heads behind the industry, we can change that narrative by incentivizing better behavior. And you can't do that unless you're in it.
Yeah, that's great. I definitely I've dabbled a bit in oil and gas. I'm not really a gun guy myself, but I'm not anti-gun either. And I've got a lot of certainly a lot of friends, a lot of investors, and in Texas, and definitely agree. We should talk a little bit about oil and gas and some of the tax incentives as well. I only discovered this a couple of years ago,
Mhm.
just because some of my investors, had active W-2 high earners, and real estate only does so much if you have passive loss limits. So, just for somebody who's kind of completely unaware of the tax benefits, maybe just kind of talk through the value proposition of oil and gas
Sure.
investments.
So, especially if your audience is a lot of real estate people looking for other stuff, oil and gas is treated a lot like real estate in the eyes of the IRS and the government. So, it's deeded and titled type of asset. The difference is that um, because you're taking the risk of drilling for oil or natural resources, the government gives you a benefit for that. And it's an active benefit. 100% of your intangible drilling costs, which is essentially the cost to drill a well before you complete it, is about 80% of the cost of the well. It's 100% deductible in your first year. Under the Jobs Care Act, it was 100% of your tangible drilling cost up until 2022. Um, could be deducted in the first year. Now I think we're down to 60%. So it's scaling back down. I think after 2026, it goes back to being required to be depreciated over 5 years. So this is really good again for high income earners W-2 because you don't necessarily have to be out there drilling a well to take an active loss. Now we don't invest in oil and gas solely for losses. So you always want to make sure that you're looking at prospects that can return something. I'm 5 generations in oil and gas. My family's assets have been paying monthly revenue checks from its wells for over 80 years. So you have the potential to own a legacy asset when investing in oil and gas. You can also exit after your clawback period. Typically, you want to stay after 3 years so that you're not having to pay back a bunch of tax write-offs, but it cash flows within 6 months of completion. So if you have a successful well, you're going to start receiving revenue checks from that production in about 6 months. So because oil and gas works about 60 days in the rear, so let's say you have a completed well, they're going to do a month of production, then they're going to do a month of sales, and then they're going to start trying to send out revenue checks. So if you had a well completed in May, you're not going to see that May revenue check until July or August. And then you'll receive it every month for that, then June, July, etc. And for the rest of eternity until the well depletes. The other benefit that you get from investing in oil and gas is that the income that you earn from oil and gas royalties, it has a 15% depletion allowance. So you're only paying income tax on 85% of that income. So it's extremely tax advantaged. I manage a completely separate oil and gas fund solely for the purpose of people wanting to get access to oil and gas deals. Um, I do family office partnerships in the oil and gas space. So, we're invested underneath like Exxon, Occidental, EOG wells, but we're directly invested at the lease in the wellhead. So these aren't things that I'm waiting for a check from Exxon because of my dividend paying stock. It's because I'm literally the second person getting paid, underneath the royalty owner, which is the safest way to invest in oil and gas. It's just not as tax advantaged. I love talking about oil and gas investing because I've done it my whole life. Um, if you're looking to invest in oil similar to like a real estate project, um, royalties like mineral rights are a piece of real estate. In most states, they're separated from your surface rights. So a farmer who has 10,000 acres could sell, 100 acres of their mineral rights and still have cows on their property there. And then they're going to be earning royalty checks. They don't have any exposure to drilling risk. They don't, depending on the state, pay property taxes. Um, and they just receive monthly income from whatever well is drilled and producing on their property. In some states, it includes water rights too. So it's a pretty lucrative um, asset because it's literally just a title change from one generation to the next.
Yeah. So what you described that really hit with me, and actually, we've had prior guests on here in the oil and gas, and I've made a few personal investments just to test the waters. But when you mentioned that you could actually invest sort of alongside like an Exxon, I think I'm familiar with that concept, and that's like really super powerful as opposed to there's been a bit of a negative reputation in the industry from time to time, whereas you get the tax write-off and the money never comes back. So I've heard that number one, the technology is so much better now with the fracking and the geological studies that the likelihood of just a dry hole is way lower than before. But the ability to sort of piggyback on some of the larger groups so that you're not sending some money to some Yahoo that's like drilling one of those little teeter-totter things. These are like multi-million dollar or hundred whatever tens of millions of dollars of exploration from bigger companies that you're going along with, not just some mom and pop drilling in their backyard.
These wells are $15 to $25 million each. So the people that we partner with are writing a $95 million check and we're coming in with $1 million and a couple of our buddies, right? So it's a very different investment strategy as opposed to like, oh, let me drill one well with this small operator. We have exposure to small owner operators, and that's just because we want to stay diversified. So we're not just investing in one project. The fund invests across a bunch of different projects, and they all have their different economics. So, the one thing that we look for, and this is just us, is that can the well produce a profit at $55 oil, sometime within 3 to 5 years, and can we see our capital back in that first 24 to 36 months through tax incentive and income? And if the project can perform at that level, then that's something that we're going to be seriously considering and have invested in. We're at $75 oil, and we have been for over 2 years. So there's significant profit built into a project that we bought in at $55 oil. Now it's at 75. And the same goes for natural gas. Natural gas has been like $1 for a decade, and we had that little blip of $11 a couple of years ago. But we're still buying assets at $1.50, $2 gas prices, which we're still making money on, right? Like we're only investing at $2 gas if it's going to turn a profit. So anything, as soon as it goes a little bit above $2, like we make more money. And I think that's why there's still people who are at least familiar with the industry, still heavily investing and super bullish on natural gas specifically, especially family offices that are intending to hold these things for 10, 20, 30 years.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.